There are several early signs of recession that investors look out for.
One tool that's commonly cited is the yield curve, right? The yield curve inversion. When the yield curve tends to invert, it means that people expect that the bond market expects interest rates to be higher in the short term than it does in the long term. That's because the Federal Reserve hikes rates to control inflation, and then after inflation is controlled, it cuts interest rates back down. So if you see that the market expects high interest rates in the short term and low interest rates in the long term, that's indicative that a recession is coming, followed by an interest rate cutting cycle.
A lot of people look at some of the manufacturing indices, like the ISM manufacturing index. When it tends to be above 50, means that the economy is expanding. But when the ISM starts decelerating and approaches 50, a lot of people say, okay, the manufacturing side of the economy is going to contract, that could be a recession indicator. Third recession indicator that a lot of people look at is consumer confidence, and suggest that, well, if consumer sentiment and consumer confidence goes negative, that means consumers are going to pull in, take the credit cards away, and not spend, and that could cause a contraction in the economy.
A diverse portfolio can often provide the best defense.
Diversify your holdings of assets to make sure that you're including not only growth stocks, but more value stocks and more defensive stocks.
Like healthcare, like the utilities market. These are the companies that could manage through this process a little more effectively than some of the hyper growth firms that are leveraging the credit market more so than maybe a company with a ton of free cash flow and really strong balance sheets. And that's why I think there can be some value in recessions, not too deep and not too long, but in scenarios where we are overheating, assets have gotten way out of whack, and we need to get to a point where they get back to fair value.
It also creates opportunities to be a stock picker. It's very hard, to buy stocks in a bull market, but very often recessions and the bear markets that come with it create brief opportunities to really reload your portfolio, to buy the stocks that you've wanted to own, essentially at sale prices.
But whether recessions are actually good for the economy remains widely debated.
Look, recessions are very healthy things for the economy because ultimately recessions flush out excesses. So you think about it, when we have a recession, it reduces whatever extreme bubbles may have built up.
I think that's ridiculous. This notion that somehow we need to cleanse the system and a recession is a cleansing thing. It's like saying everybody should have a heart attack once in a while because it'll make them eat better and exercise more. It's just not true.
Recessions cause job loss, and every job loss is enormously unfortunate. Becoming unemployed is enormously disruptive to people's lives. It causes enormous pain for families, for households, for communities. It's terrible.
For Americans, understanding how recession works can best help them prepare for whatever may lie ahead.
Understanding, the dynamics of a recession allow you to potentially be, more opportunistic and protective of your wealth, should these downturns happen. Knowing that it may be coming, can help you think through decisions about, do you want to buy a house or do you want to rent? Do you want to take a new job or do you want to, maybe wait because the job market, may soften up. These are all things that if you possess the knowledge of the business cycle can help you manage your financial life in a much better way.